Okay, good morning, everybody. In the last few lectures, we were discussing regarding cost of capital. And as you are aware, cost of capital can be calculated with the help of cost of equity, cost of debts, and cost of preference. In the previous few videos, we have discussed about the cost of preference and cost of debts. In today's lecture, we will make an effort to discuss about how to calculate cost of equity. And as you are aware, equity shareholders, they are the owners of the company. That means they participate in the profit as well as in the loss of the company. Equity shareholders, they are supposed to receive the amount of dividend out of the profit after meeting all the liabilities in the form of interest to the debt holders as well as dividend to the preference shareholders in the fixed form. But as they are owners, they are not getting any amount of fixed interest as well as they do not receive any amount of fixed amount of dividend. After meeting all the cost as well as accountabilities in the form of interest and preference dividend, remaining amount of profit has to be distributed among the equity shareholder as their portion of profit, we can say as earning per share as a dividend. That means the company is unable to make the promise that what is the amount of dividend they may pay to the equity shareholders. And quite possible, whatever the amount of dividend they pay in the current year, they may vary in the next financial year and next to next also it may vary. That means the flexibility, the varying nature of dividend will be there with respect to equity shareholder. That is why it becomes difficult and tedious to calculate the cost of equity. Because the amount of dividend they are giving, the company is giving to the equity shareholder, that amount of dividend will be considered as the amount of cost of the equity itself. As sometime the company may give the dividend as a constant dividend, sometimes there can be a growth, and sometimes there can be a supernormal growth also in the amount of profit. So in this way, the profit amount varies. In the same way, the dividend amount will also vary. So keeping in mind, as equity shareholders are not getting the amount of dividend in the fixed form and interest also not in the fixed form, their amount of dividend will vary from year to year depending upon the profit which is remaining in the hand of the company after meeting all the cost as well as after meeting all the amount of accountabilities. As the dividend amount is not fixed, it may vary. That is why for calculating the cost of equity, there will be few methods that we are supposed to consider. First method we can say as dividend yield method, which is also called as zero growth dividend model. That means the dividend will be there, but there will be no growth, which is called as dividend yield method. The second method will be growth dividend model, which can also be later on called as normal growth, and if the dividend is going to increase, it can be called as supernormal growth. Here we are taking into consideration that there will be growth in the amount of dividend year to year. Third model will be PE model, that is price earning model, and fourth will be on the basis of CAPM, that is capital asset pricing model. So these four models or method will be considered for calculating the cost of equity depending upon the amount of dividend that we are having at the end of the year. In today's lecture, in this video, we will take up that how to calculate the cost of equity with respect to dividend yield model, and that we will make an effort that to understand the concept as well as to know that how to calculate the cost of equity if there is zero growth in the dividend, or we can say as dividend yield model. So in the last few lectures, we have discussed about the theory, concept, and numerical aspect of cost of capital. As we are aware, this cost of capital will be calculated with an average cost of equity, cost of preference, and cost of debts. In the past few lectures, we have discussed about how to calculate the cost of debts using the formula as well as trial and error method. We also made an effort to calculate the cost of preference, and in today's lecture, we will discuss how to calculate the cost of equity. As you are aware that equity shareholders, they are the owners of the company. That means whatever the amount of profit remains after giving the interest to the debt holders and dividend to the preference shareholders, the remaining amount of profit has to be shared among the equity shareholders. And if the company do not remain with any amount of profit after meeting all the liabilities, then no amount of dividend has to be paid to the equity shareholders. Equity shareholders do not carry any fixed rate of dividend, and there is no coupon rate also. That means the calculation of cost of equity will be tedious. It will be difficult to calculate the cost of equity, because as the preference shareholders, they were having the fixed dividend and debts were having the fixed rate of interest, that is the coupon rate. Such fixed dividend and fixed amount of interest is not given to the equity shareholders. Equity shareholders, they are paid dividend on the discretion of the board of directors, and board of directors will decide whether to make the payment of dividend or not to make the payment of dividend, and what should be the rate of dividend. That has to be decided by the board of directors of the company. But as you are aware that they are the owners, so they also have the expectation to receive some amount of return on the capital they have invested in the company. We have discussed how to calculate the cost of debts, as well as we have also discussed how to calculate the cost of preference. The same model can be used for calculating the cost of equity. You can see in the formula that while we calculate the cost of debts with the help of trial and error, this was the equation that we were making use. P0 is the market value of equity share here. D1, D2, D3 till Dn, they are the expected amount of dividend at the end of the year 1, 2, and the nth year. KE is basically the rate of return, or as we can call as the cost of equity share capital. This we have to find out. And PN, that is the expected selling price of equity shareholder at the end of the year N. Again, P0 is the market value of equity share. This is on the left hand side, and the other is on the right hand side. That means again, with the help of trial and error method, we have to assume the value of K as we used to do in calculating the cost of debts. And we have to bring the summation of right hand side equal to the sum value of left hand side. The rate of KE at which right hand side equal to left hand side that rate will be called as the cost of equity. Very simple method, the same as we did earlier. But along with this, we have other types of calculations with respect to cost of equity. Because equity is basically a non-fixed instrument. That means the amount of growth, the rate of growth cannot be predicted. That is why there are certain methods which can be followed for calculating the cost of equity. Sometimes the equity gets the normal growth. Sometimes they get zero growth. And sometimes they get supernormal growth. And moreover, we have the models also, like the price earning models, PE model that we say, and capital asset pricing model, CAPM. So what we can do that we can make an effort of calculating cost of equity with the help of certain methods. Methods for calculating cost of equity. Means here we can use like the method we can say as number one, dividend yield method. Dividend yield method, or which can also be called as zero growth. We can also call it as zero growth dividend model or method. Dividend method. Secondly, we can take dividend. Here the growth is zero, only the dividend that we are aware. Secondly, there can be growth in the dividend. We can say as dividend growth model. Which sometimes is also called as normal growth. Normal growth. Third method we can say, and along with the normal growth, we can say that we also have in the growth model itself supernormal growth. The concept of supernormal. Thirdly, we can say as price. You must be knowing about the PE ratio. The same thing, price earning model. And the fourth that we'll take up is capital asset pricing model, also famously called as CAPM method or model. So we will take up one by one. These will be the four methods through which we will take the help of these methods for calculating the cost of equity. First one we take up, that is dividend yield method. Dividend yield method. This will be our discussion for today itself. Dividend yield method is one of the most simplest method. And here the growth is basically not considered. That means we are aware that if the company is remaining with any amount of profit after meeting the liabilities in form of making the payment to the interest as well as fixed dividend to the preference shareholder, the remaining amount has to be paid to the equity shareholders. So for calculating the cost of equity with respect to dividend yield method, means the assumption has to be taken. The assumption has to be taken that this method is that in which the market value of equity share is directly related to the future dividend expected. This I can write here. The basic assumption of this method is that the market value of equity share is directly related to the future expected dividend. Means for calculating the cost of equity, the simple version that what we can write here is, you can see that it is the discount rate. That what is this? It is a discount rate that equates the present value of all the expected future dividend per share with the net proceed. And for writing the equation, we can write the equation in this form. That dividend divided by the net proceeds. Dividend divided by net proceeds. This can be the equation for calculating the cost of dividend with respect to dividend yield method, or we can say as zero growth dividend model. This is your dividend, annual dividend per share in the period 1. The current market price of the equity share, which is also called as net proceed per equity share. I am saying current market price of the equity share, not the issue price. It is the current market price. So dividend divided by the current market price, also called as net proceeds, it can give us the cost of equity as per this model. Basically, shareholders always expect to have the growth in their investment, and they expect that a dividend amount is going to grow. So in practical situation, this model is not feasible from the point of view of the investors, because this model fails to consider the growth rate. That if the growth is there, then this model will not be applicable. But still, if the growth is not there and there is a constant itself, future expected, then we can make use of this equation. Like one example that we can take up, that how to calculate this. I give you an example itself. Question. See. X Limited is expected to distribute dividend of rupees 28 on each equity share of rupees 10. This is the amount of dividend to be distributed. This is the face value of the equity share. The current market price is rupees 75, and we have to calculate the cost of equity. So the dividend is also given. The current market price is also given. So simply we can put the equation and we are able to get the solution. 28 upon 75. 37.33% is the cost of equity. Another example that we try to take up where some calculation will be also there. Try to do it because practice will make you perfect. Read the problem very carefully. What they say, X Limited issued 10,000 equity shares. Number of equity shares they are saying of rupees 10 each at a premium of rupees 2. 2 is the premium amount. That means 10 plus 2, 12 rupees. The company has incurred expenses for the issue of rupees 5,000. That means for making the issue of these equity shares, company has incurred expenses of rupees 5,000. Why this information is given? Because we have to calculate the P0, or else you can say as the net proceeds has to be there. The equity shareholders expect the rate of dividend to be 16% per annum. 16% per annum. 16% of rupees 10. That will be 1.6. Rupees 1.6 will be the amount of dividend. Calculate the cost of the equity share capital. What will be the effect on the cost of equity if the given current market price of equity share is rupees 20? That means we have to make an attempt to calculate cost of equity in two respects. One, considering the net proceeds, because the information has been given with that respect, and another, the cost of equity with respect to the current market price. Two situations have been given. So when we try to calculate from the first situation, rupees 10 is the amount of equity, 16%. So dividend will be, dividend we can say, as per this information, it should come as 1.6. This will be your amount of dividend. Right? Now, if we look the other information, the net proceeds, 10,000 equity share at the rate of rupees 2 as premium. That makes 12 rupees. So 10,000 multiplied by 12 rupees. And 5,000 is the expenses. Means I am trying to calculate the net proceed per share. That what is the amount of equity share per share. So we can say, what we can do, that we can calculate the cost of issue minus the expenses divided by number of shares. And if you try to do this, you can find the P0 per share in this way. This is your net proceeds. 10,000 number of equity shares multiplied by rupees 10 minus 5,000 expenses divided by 10,000. And if you solve this, it will come to as 11.5 per share. 11.5 per share. That means now we have to calculate the cost of equity. So dividend upon net proceeds. Dividend is 1.6 and net proceeds is 11.5. So automatically you can get the cost of equity. And that comes to 13.91%. 1.6 divided by 11.5. It is coming as, that means the cost of equity, that means the company is supposed to give 13.9 as the return on the equity shareholders per equity share. In this problem, the company has also given us the information with respect to the market price. Market price per share is also given as rupees 20. So in place of 11.5, now we can use rupees 20 cost of equity. It comes to 8%. That means 1.6 is the dividend and 20 is the current market price. That means the cost has decreased from 13.9 to 8%. That means if the current market price is going to increase and the dividend amount remain to be as constant, automatically the cost of equity to the company is going to reduce or is going to decrease from this equation. Right? I hope I made you understood that how to calculate the cost of equity with the help of zero growth method. Zero growth method, or we are also called as we have seen, that it's called dividend yield method itself. Right? Thank you all of you. In the next lecture, we will take up the second aspect, that will be dividend growth model, where we will see that how the growth is going to bring changes in the cost of equity if it is normal growth or having the supernormal growth. Thank you all of you.